And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Luke Smith, good afternoon.
Good afternoon.
I'm tempted to say it again. We say it every week. How's it Friday already?
Mate, I don't know.
No, there we go.
How are we at the end of May?
That is the bigger question, isn't it? We've got one more week of May left in front of us, and then it's June, and it's tax time, and it's all of lots of things to talk about over the next month, aren't there?
Plenty coming.
Absolutely. But today's topic is why having an advisor may save you a fortune. Now, I'm going to be really cynical here, Luke, and I'm going to say in order to save a fortune, you need to have one to start with.
Well, that's true, and I think fortune, you know what, it's Friday afternoon, we can have a little bit of poetic licence, can't we?
Indeed. But in all seriousness, of course, expert advice is expert advice for a reason, isn't it? It's if you try and navigate a lot of things yourself, the chances are you're going to make some mistakes that will cost you money.
Yeah, and look, when I say get an advisor, I'm not just talking about me and my industry. I'm just pointing out, I guess, the value in the generality of this is what people need to be thinking about, because the recent budget proposals are a great example of, oh, wow, what does this mean? Does it affect me? How does that happen? How does this work? Is this applicable? Is it not applicable? Is that good? Is that bad? Tell me about this. Tell me about that. That's where you need help.
Oh, yeah. Well, it's a week and a half since the budget already, and there are still things about it that I haven't yet have clarified.
No. And I think that's a good thing for people is there's plenty of things where the devil's still in the detail.
Yeah,
and we don't know that yet. And I think next week we got Reece Keeber's coming in from RSM just to talk about the tax side, to provide a little bit more clarity around what we do know and also point out what we don't know.
Yes.
And there's a great example. So, you know, I'm grappling with changes, implications, and on my side of the world, CGT, family trusts, testamentary trusts, those sorts of structural changes are significant. From a tax perspective, you're looking at CGT, small business, the sale of assets, trusts, distributions, et cetera, et cetera. So there's a lot to consume. From a legal perspective, now you're talking about the effect of people's estate planning. So family lawyers are probably sitting down and okay, let's decipher what's gone on here. What are the pros? What are the cons? And I think what a lot of people need to take out of it is if you go this alone, there are opportunity costs for just not doing something. And one of the things that I love is sitting down with people and saying, okay, right, where are we at? What are we doing? And the first thing they'll say to me is, look, Loogie, we've just come in to make sure we're not missing out on anything. And that's cool, right? Because that's great. And you can sit down and say, well, are you doing this? Or what's that? Well, this is how this works, and you've got the ability to do this, this, and this. And if you did that, you could save $3,000 or $4,000 between now and the 1st of July. Oh, wow. How cool is that? And you could do that for the next 5 years. Wow. What a great use of paying for an hour's time to have something that you can repetitiously use from a strategy perspective that could be worth 4, 5, 6, 7, 8, 9, 10 times what you paid for an hour of my time, an accountant's time, a lawyer's time. Take the family law side. You know, if you've got something that comes out of super and you don't have it structured correctly, you could lose everything you've worked for because your son has an argument with his girlfriend and she says, I'm having half. That's not great. So you pay some money to have a well-written document so that you can protect your assets from a generational perspective. From an accounting side of things, well, I'm just going to do my own tax and because it's not that difficult. Well, you know what? It probably is. And there are instances where you don't need anything too overly complicated. You also don't need, Ernst & Young for a small business. So you've got to find that happy medium of the legislation and the strategy considerations that affect you and your operation, and can you make the most of it? Now, a good accountant is great at working through the weeds and giving you advice around cash flow and budgeting and expenses and deductions and FBT and all those other acronyms that they love throwing around. But can you really, chance it on your own? That'd be like giving me a hammer and some nails and go and build a deck. Jeepers creepers.
Well, yes. I know, Luke, I could do it. I just don't want to do it.
Oh, I couldn't do it.
It's like building a deck. Yes, I could do it, but I don't want to do it.
I could probably do it. It might not stay up, though.
It's the same with tax, personal tax from my regular working job where I've got a regular salary and regular expenses that are deductible. Yeah, I could do that. I just don't want to.
No. And somebody like me sits down and says, well, are you maxing out deductions? Are you using the non-concessional legislation? Are you undertaking a recontribution strategy to manage your estate planning? Have you separated your taxable and tax-free components? Have you used the CGT small business concessions? Are you carrying forward or looking back 5 years in relation to concessional payments? They're all the sorts of things that I'm interrogating to make sure that you haven't left opportunities on the table. Because you may or may not understand what the legislation allows you to do. And more importantly, you might understand it, but I find a lot of people don't know how to execute it or the rules around the execution so they don't get it wrong. Now, for me, that is hugely, hugely valuable. And as a proprietor or somebody that pays for advice from a range of areas, the satisfaction of knowing that it's okay is great. And it's one of those things. People in a certain industry or any industry, and this is a generality, assume that everyone understands what's going on. That could be the building game, tax, anything that happens in life. You're very good at what you do outside of that, maybe not so. And the people that are coming to you aren't going to have the knowledge that you have, which is a great thing, which is why you pay for it. So get people around you, as we said the other week, from a social perspective, from a professional perspective. Get a good team of people around you, because then you know you're going to go through your working life effectively bulletproof. You don't have the angst, you don't have the worry, you don't have, that concern that, well, what if this happens? Because you can lean on people to be able to get the professional services that you need. And there's a very good chance that the people involved around you all know each other. I find that more often than not is, a lot of my clients say, oh, I've ended up in this net of people I can trust, because you all know each other. And that's wonderful, because they know no matter where they go, they can just say, oh, listen, ring him, get her, she can do that, he'll fix that, and we know what's happening. So I think if people can understand the strategies that are available to them, why would you guess with Centrelink? It's hard enough. That's why I've got no hair.
Now.
Having to deal with Centrelink for clients. That's enough to take my hair.
You still have plenty of hair. Look at me.
Well, the other one I've learned recently, do not die with a benefit in the PSSAP.
Oh, okay.
Right? If your family like happiness, do whatever you can to not die with a benefit in the PSSAP, because I can tell you that is an excruciating process that nobody should have to deal with. So there's a little tip. If you're thinking you're going to die or you've got a benefit in there and you're sick, get it out. Go anywhere else than deal with them in relation to a death claim. It is torture.
It can be a little difficult sometimes to predict when that's going to happen, of course.
Yeah, true. This is very true. So, take from that what you will. You can't say you haven't been warned. As someone who's seen just about everything in 26 years, that still shocks me. Yeah. But again, understand the value of what you have. Understand the value of what you're using. Understand the differences between super funds. And I say all the time, a mini won't pull a horse float. That doesn't mean we don't like minis. They have a purpose. They have a role. All super funds do. But if you think you're in a Ferrari, but really you're in a busted Datsun, you're going to be sadly mistaken to find out later that, oh, you mean I can't? And that's where people need to understand the value of a structure in line with the things that are most important to them. And it's generally controlling income, controlling tax, maximising franking credits, lots of choice, lots of control. They're generally the 5 things that people come in and say to me, this is what I want.
A busted Datsun may not go as fast as a Ferrari, but it's a lot cheaper.
Exactly, and look,
it might suit your needs.
Well, and that's what I'm saying. There's a role for everything out there. It's not that this is better than that, but you can't compare a Mack truck to a Ferrari.
No.
Yes, they're both vehicles, but they're very different vehicles. And super funds are the same. Now, 90% of people aren't going to break that down. They're not interested in that, and they come to somebody like me and go, "What's best? I want A, B, C, D, and E." That one. Okay, great. You don't have the time to be looking at that. Generally speaking, most people assess the value of a super fund in 2 ways. Cost, performance. But how do you compare performance when you don't understand the speed the car's going at? I'm imbalanced. And we've had this conversation. I'm imbalanced. Well, what does that mean? I don't know what it means.
Well, apparently, from what you've told me in the past, nobody knows what it means.
And it could mean
it's not actually a defined term. It's just a marketing label. Yeah,
it's a label. So again, it's really, really important that you come to somebody, because and I see this all the time, my super, it's not earning any money. Well, you've got 85% in cash. Oh, is that what that option does? That's a very expensive mistake to make over a 5 or 10 year period, because you didn't want to spend an hour talking to somebody that could have pointed that out in the first 35 seconds. You don't know what you don't know. I get that.
Mm-hmm.
That's why I said it like 20 years ago. But people need to understand that everybody's situation is different. Just because the ladies at work have that fund, or they do that, or they have that, or they buy that, doesn't mean it's right for you. And that's the thing that I think people need to get from advice is, with how I feel, is what I'm doing appropriate? Yes or no? And can I improve the way I do it? A lot of the time I say to people, that's great, that's great, that's great. If you just did that bit like this, we've got a little bit more juice out of the grape. But keep doing it. Unreal. And they go, can I do that? Yeah, great. And play on. So get good advice, get good people around you. And the chances of you finding out, walking into my office at 59 and a half and going, hey, Luke, I'm going to retire at 60. So this super thing, should I be looking at it? It's probably why you and I are sitting here so many years later, because that kills me. If you can just be aware and be engaged, you compound your strategies over a 10 or 15 year period of your working life. The difference is exponential, and that the peace of mind that comes from that is ultimately then that's the big bag of gold at the end. It's the peace of mind to know you're okay.
I can't remember where I saw it, but there was a great story in one of the newspapers last week about the impact of compound interest and compound returns. And it was explained that's why vampires are always super wealthy, because they've lived so long.
There you go.
They've had the opportunity to reap the benefit of compounding returns.
And I say all the time, if you can do a little something a little sooner, if you've just had kids, right, get an account open. Get a high growth option, throw $10 a week into it and leave it alone.
Yeah.
Your kids are set. That's all you got to do.
Yeah, the simple reality of compound returns is the sooner you start, the bigger the returns.
Exactly right. Throw in a little bit and leave it alone. Shut your eyes, it'll take care of itself.
Luke Smith from Envision Financial is with me today, and we're asking why having an investor might save you a fortune. I think we've made it pretty clear already. Luke Smith from Envision Financial is with me in the studio, and apparently before the break I said the word investor instead of the word advisor. I don't know why, just one of those slips of the tongue that do occur from time to time. But yes, the topic today is why having an advisor may save you a fortune. So Luke, what do we need to remember?
Yeah, so if I had a list here, the first one would be, it's not supposed to be difficult, don't be frightened. You'll probably have a laugh and learn a lot while you do it. So it's not an interrogation. No one's going to take your money. Nobody's going to tell you you've got to live on beans and eggs, right? But, get some help. Because what are they there to do? They're there to try and make sure you get the best possible outcome. That's all. So you're the winner no matter what happens. An advisor will also help you manage expectations. This one's a big one, right? Because everybody thinks they're the same as everyone else. And everybody comes in and goes, Luke, we're just average people. We're not extravagant. And I go, that's wonderful. After all these years, nobody that's extravagant. And then the next line out of their mouth could be, I just need this much to live on. And you look down at the resources and go, okay, or we better have a chat about that. So managing expectations is important. I think lowering tax is also important, where you're not taking advantage of opportunities or understanding the legislation that's available to you, whether you use it now or later. I'd always rather someone understands what it means, understands how they can use it, because their situation might change 3 weeks after they walk out of my office and go, now I could do that. So information is vital. How you then use it is relevant to your situation, which I think is very, very important. You need somebody that can hold your hand. I think a lot of people say, well, don't leave me to do this because I don't know how to do it. That's okay. I'll hold your hand. It's fine. I've got a great team of people in the office who, a lot of people say, well, we don't need you, Luke, as long as the girls are there. That's great. And it's probably true. Because they're the ones that pay your bills, pay your credit cards, buy your boats, they pay everything. So I just want people to be retired. I don't think you should retire and become an administrator. That the onus is on me for that, to make sure that you've got the flexibility to do whatever you want. And I think that's part of a very strong value proposition. I think it's also important to understand how you feel about risk and ensure that your money's invested accordingly with how you feel, not with what you think you feel or what you think you're in. So again, clarity around risk, clarity around opportunity, clarity around cost. Because if you're not getting help, what are you missing out on? 2 or 3 deductible contributions or strategies from me, you might be $5,000 or $6,000 better off. You might be $15,000, $20,000 better off in the next 3 years, and you've paid for an hour of time. Really? And my fees are tax deductible. So you're claiming them anyway. It's pretty good. And that's the case with most professionals, accountants and, where you're generating income and they're involved in that process, generally speaking, they're tax deductible. And again, that's where a good accountant can explain to you what is and what isn't, so that you can make informed decisions. And that's what any advisor wants, regardless of their field, is for the ability for the individual to make informed decisions and have peace of mind. We just happen to use investments, super trusts and shares and ETFs to provide that peace of mind. But at the end of the day, I just want people to be able to sit down and go, oh, that's okay, and then get on with their holidays. Because that's what I'm there to do. I'm there to just let you breathe out and go, I will be all right. I'm not on my own.
So, Luke, where can listeners get more information?
Yeah, office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube. And we've got Smart Money Strategy, your ultimate guide to financial planning in all good and bad bookstores.
Absolutely. Well, that brings us to the end of today's program, but next week we'll bring in a specialist to have a chat about some of the changes from the budget.
That's right. We've got Reece coming in from RSM to talk about the tax implications of the budget.
Indeed. Thanks very much. Luke, back again next week.